There's a quiet tension building beneath the surface of Canada's housing market. One that hasn't fully made headlines yet, but is slowly becoming impossible to ignore. It's not a crash, it's not a sudden collapse, it's something more subtle, more gradual, and potentially more dangerous. Many are starting to call it Canada's mortgage time bomb. Over the past decade, Canadians stretched themselves to enter the housing market. Low interest rates made it possible. Monthly payments felt manageable. Home values kept rising, and for a while, it seemed like the system worked for everyone. But what made home ownership accessible then is now what's creating pressure today. Before we move further, friends, you all know that the moment we reach 2,000 subscribers, your name will go in for a draw if you're subscribed, and one winner gets $250 Costco gift card. Also, when we reach 10,000 subscribers, we have another draw, and again if you're subscribed, one winner gets $2,000 cash, which could go towards your mortgage payment or rental payment. Both these promotions are published on our website. Just by subscribing, you get your name in for the draw. And friends, since you're watching my videos in thousands and thousands, just hitting the subscribe button may make you win. The names of the winners will be declared on this channel. Wishing you all the best for the same. And coming back to today's topic. The foundation of this time bomb is simple. Millions of mortgages taken at ultra-low rates are now approaching renewal in a much higher rate environment. Between 2020 and 2022, Canadians locked into some of the lowest borrowing costs in modern history. People bought first homes, upgraded to larger ones, and took on bigger loans because money was cheap. A $600,000 or a $800,000 mortgage didn't feel as intimidating when interest rates were near historic lows. Payments were predictable, confidence was high, but mortgages don't stay frozen forever. As we move deeper into 2026, a massive wave of renewals is approaching. And for many homeowners, the numbers they are about to see will feel like a shock. A mortgage rate once that started at 1.8% or 2% could renew to 5 or 6%. That difference just doesn't look big on paper. It changes real monthly budgets in a very real way. For some households, this could mean paying hundreds or even thousands more per month. And it's all happening at a time when the cost of living is already high. Groceries, property taxes, insurance, childcare, and daily expenses have all increased. There's less flexibility in the average household budget than there was 5 years ago. That's why the situation is being described as a time bomb. Not because everything will explode at once, but because pressure is building slowly and quietly across millions of homes. The impact won't be the same for everyone. Some homeowners have stable incomes, strong savings, or smaller mortgages. They will adjust and move forward. But others are walking a tighter financial line. Those who bought at peak prices, stretched to qualify, or relied on variable rates during the low rate era may feel strain more intensely. The real risk isn't just higher payments, friends. It's what those higher payments force people to do. Families may start cutting back on spending, savings may shrink, plans to invest, travel, or renovate could be put on hold. In some cases, homeowners may look for ways to restructure their debt, extend their amortization, or use their home equity just to keep monthly costs manageable. And in more difficult situations, some may consider selling earlier than they planned. Now, when this happens across thousands of households at the same time, it creates a ripple effect. Consumer confidence dips, spending slows, and the housing market starts to feel the weight of more cautious buyers and uncertain sellers. But the most important thing to understand is that this time bomb isn't about panic, it's about pressure. Canada's mortgage system is designed to renew every few years. That structure works well in stable environments. But when interest rates rise quickly, renewal becomes a moment of truth. It forces homeowners to confront the real cost of their home, not just the price they paid, but the long commitment it requires. This is the phase the market is entering now. For years, low rates created a sense of comfort. People got used to affordable borrowing and rising home values. Now the system is shifting. Payments are recalculating, budgets are tightening, and homeowners are being tested in ways they haven't been over in a decade. That's why 2026 feels different. Not because homes are suddenly worthless or because the market is collapsing, but because the financial reality of owning a home is changing all at once. Canada's mortgage time bomb isn't a single event, it's a slow countdown made up for renewal letters, new rates, and monthly numbers that don't look the way they used to. And for many Canadians, the moment that letter arrives in the mail may be the moment they truly understand what their home really costs. Friends, should you or someone you know is going through all this, please call back as you always do and talk soon. Thank you very much.